Let's look at some hot stock tips for 2020. Hello everyone, Florian Heise here, and welcome to another episode of HeiseSays. I've got my morning small stein of coffee, and I thought we'd have a look at this article from the ABC because it's discussing stock tips and the surge that they're predicting due to cheap money. Now, if we hit QE, which our governor says will happen when we go to a cash rate of 0.25. I know in a previous video I said 0.5, but I was just too excited, guys, at the prospect of all these, large corporates getting free money. So if we hit 0.25, which is only 2 more cuts, and we have one predicted in March, there'll be a lot of purchases of bonds, and I think that's the main way the Reserve Bank is going to do it. In the States, there was even purchasing of certain securities. But essentially, that's going to be a flood of money. And where will that money go? A big chunk of that money will go into the share market. Will it actually flood through to the average person and stimulate the economy? Well, let's just look at Japan. Has it worked there, guys? Anyway, let's have a look at this article. And if you have any stock tips or hints, let them know. But remember, everyone, always do your own thorough research. Don't trust the talking head on YouTube. And don't trust an article. And if you're gonna throw money at something, make sure it's something you can afford to lose. I mean, that's just common sense. The number of stories you hear about people mortgaging their house, losing everything, going into some BitConnect scam or something to get rich quick, it's depressing. So let's have a look at this, guys. This year could be another where you feel trapped between a rock and a hard place in least regards to financial decisions. Putting all your money in a safe place, like the bank, may leave you poorer in real terms. Well, is a bank a safe place? It depends. That's because the cost of living is rising more quickly than what you're earning from your savings account. In most cases, not much better than zero. Well, yeah, interest is nothing, essentially. Your fees eat up your interest, often. Left with little choice in this record low interest rate environment, many have turned to the share market in the hope of making a half-decent return. With borrowing costs low, many have also taken advantage of the cheap money to invest in companies, driving up share prices to overstretched valuations. See, now, this is what we're happening. This is a sign of artificial interference in the market, intervention, which is driving interest rates much lower than they should be. And just look at Europe. Look at all the nations that have negative interest rates. I know that's not discussed here, or not planned for Australia. But if QE, that's just going to decrease the purchasing power of our money and lose value there in inflation. So, the ASX 200 jumped by about 20% last year, while Wall Street's benchmark index, the S&P 500, surged by 29%. Both were surprisingly strong results considering bouts of panic selling, massive rebounds, then panic selling again. Well, remember, guys, every time there's a tweet about the trade war, every time, the market was going up. Every time there's a hope. There's still stuff in the media now talking about within the week there'll be a deal signed with the US and China. So some of this can be pinned on US President Donald Trump and his unpredictable, market-sensitive Twitter outbursts through 2019. I put an argument to you all that Trump has made Twitter relevant. It's just the den of leftist losers who prattle on about social justice issues and people who want to bait them. Now, more people are responding. Maybe I'm just catching up and getting into Twitter. I never found it that interesting, to be honest. So here we go. Have a look, guys. The Banking Royal Commission final report, boom, shot up. Federal election, LNP government, boom, shot up. The first rate cut. And there we go. And the ASX finally beats previous record. US-China relations deteriorate. Look at that dive. Third and final rate cut for the year. Boom. China trade talks back on track. Up, down, up, down, up, down. So trending up, but there's a bit of volatility in it. An all-time high. ABC News interviewed 5 market professionals for their thoughts on where the share market is headed this year. They expect 2020 to be another volatile year. Well, Yeah, I can't say anyone would be surprised at that prediction. And I mean, it's going to be an interesting year. They pointed to two factors, including Mr. Trump seeking re-election in what will no doubt be a bitterly contested race, the potential for the US-China trade war to flare up again, worries about the risk of a global recession, and the continuing uncertainty around Brexit. Nevertheless, the consensus is that global markets will continue to rise sharply. Okay, so that's the consensus. When you're in an environment where liquidity is likely to be increased, that cash has to go somewhere, said IG Markets analyst Kyle Roeder. Money is cheap, quality of stocks is reasonably good, so people are forced to chase returns in riskier assets, trying to find any return they can. It's a self-perpetuating cycle, money chasing momentum. But he expects the returns probably won't be as much compared to 2019, as there will be challenges for our market due to further Reserve Bank interest rate cuts. So the risk is on for mining and energy. So what are some of the stocks or sectors that might perform well this year? Well, before we go into this, let us know your predictions, guys. I know there are a few gold bugs in the comments, people who are investing in some of the mining mines around Australia. We're, I think the biggest producer in gold, if you don't count Switzerland, who export stuff they produce. They import as much as they export. So is that an opportunity to invest there? What else do you think? Mining and energy? Which is concerning because mining is a big part of our economy here in Australia. So the signing of a phase 1, I love how it's now a phase 1, US-China trade deal, means we're in the risk-on mood. And if China's economy continues to do well, it will benefit our resource stocks, says Shawn & Partners Senior Investment Advisor Craig Sidney. Given that US-China tensions have subsided for the time being, the experts interviewed were feeling upbeat about mining giants BHP, Rio Tinto, and Fortescue Metals. China will continue to stimulate its economy, and Chinese steel production will still be a feature, says Fiona Clark, a portfolio manager at Merrick's Capital. The experts were also generally optimistic about the oil and gas or energy sector. Energy should be reasonable, especially since oil prices are holding up okay at the moment, Mr. Sidney said. Here's an interesting thing. I was looking at the energy production here in Australia, and I'll just bring up that website here, particularly with regards to our wind production here, because it's my personal bugbear, and I've been just jumping on here and looking at all the wind farms, and we can see here for once, a whole lot of the ones in South Australia are over 60%, which is great. But often, so many times I'll go and they'll be below 30, 9%, 26%, 11%. And, I mean, this is a lot of investment in energy infrastructure that isn't used at capacity all the time. It can't be. Now, I'm looking at some GE turbine, modern turbine gas generations, or, gas turbines. Cutting-edge tech. We've got so much gas in Victoria and other parts of Australia. And this stuff is not the primitive technology from the 50s, guys. And there's just no public incentive or drive to invest in that. And that would have a benefit, a tremendous benefit on our cost of living and reduce the cost of energy production. Because, I mean, people I know, they love their wind farms. But, I mean, look how far some of these are located from the sources, the main demand for the energy. That means you need more wiring. That means you have more loss when you're transporting the energy there. And just the scale of these bloody things compared to, a power plant in an industrial area that can produce gas. But I know I've gone off topic, but there's an opportunity. But you have sovereign risk, you've got government intervention and public opinion that's affecting it. Anyway, back to the article. The price of Brent crude is around $66 a barrel, its highest value in 3 months. Stocks like Woodside Petroleum, Santos, and Origin, but Santos is probably a number one pick in that space, he said. However, Mr. Clark was not keen on energy stocks, warning that investors will be at the mercy of small groups of nations, the US, Russia, and Organization of the OPEC that can arbitrarily influence oil prices. While we're seeing OPEC and its partners do everything they can to keep prices supported, I'm just concerned they can turn the tap on again at any time and the US can increase production at any time. Isn't there an issue with a whole lot of these shale mining operations in the States and Canada not actually being profitable? But that's another topic. Any improvement we've seen in the pricing is almost artificially created, and the underlying supply-demand fundamentals don't support a strong oil price, he said. Hopeful about health. Now this is an interesting sector. Essentially it's following the boomers. Following the boomers, investing in aged care. There's one. Healthcare was another sector with bright prospects, according to the panel of market experts. Over the past 10 years, the value of Australian healthcare stocks skyrocketed by 500%, far outperforming the ASX 200, leaping by 150% during that period. In our experience, healthcare companies are high quality, consistently delivering growth and returns, said Tribeca Investment Partners lead portfolio manager June Bailu. I probably got that wrong. My apologies. They have a sustainable competitive advantage and continue to reinvest in their business to ensure that competitive advantage, she added. Ms. Clark was also enthusiastic about healthcare, naming CSL, ResMed and Cochlear in particular, but said they had valuation issues, too expensive, in other words. However, it certainly has potential if one takes a very long-term perspective. But what's going to happen with that population growth, guys? What happens when the boomers start dying out? But then again, that's very long-term, isn't it? She added the consumerization in China and the focus of the Chinese government to improve healthcare outcomes will be a theme for the next 20 to 30 years. It's not just a 1 or 2 year thing, so I'm still quite keen there. So here we go. Real estate recovers, but construction lags, and we've seen this in the building approvals. They've trended down. And is real estate really recovering, or is it just the upper quartile of houses, the posh houses? Australian home values are experiencing a rapid bounce back, stimulated by a record low cash rate, currently 0.75%, which the RBA is likely to cut again in the next few months. At this rate, Sydney and Melbourne prices are expected to climb back to record highs, reigniting fears of a property bubble. We see them, REA Group and Domain, improving in 12 months' time and expect positive outlooks statements from them in February reporting season, she said. Oh, so there you go, investing in those. But it's still too early for builders, as we believe earnings will be tough for them in 2020 and possibly into early next year, she added. Ms. Clark echoed similar sentiments, anticipating that Domain, REA, McGrath, and mortgage broker stocks could see a rebound in their share price. Even though we're seeing a bottoming in house prices, the lag in the construction industry is quite a long-term thing, 12 to 18 months, she said. We need to see an undersupply of apartments before we see an improvement in construction. Well, that's going to take a while. There is a huge supply of apartments. So, banking. Banking was the most divisive sector. Everyone had an opinion about the prospects of Commonwealth Bank, Westpac, ANZ, and NAB. I would be underweight in the major banks for the time being, Ms. Clark warned. Meanwhile, InvestSmart analyst Gravan Sochi said, the banks aren't expensive, but I question whether those yields are sustainable, noting that their margins will suffer with further rate cuts by the RBA. As for Mr. Sydney, he thought the big four banks were reasonable value as their share prices had fallen sharply since the Banking Royal Commission before rebounding somewhat. And in Westpac's case, since money laundering scandal erupted, the banks are just... they're everyone's hero. Everyone loves the banks at the moment, don't they? Bank share prices should be well supported, but they're not going to be a fantastic proposition, he said. You'll be buying their stock on the risk there will be dividend cuts at some point in the future. Meanwhile, Ms. Liu considered banking shares to be very cheap, since they offered pretty good yield, despite some banks facing more issues than others. So, temperamental tech. Opinions were also divided on Australian technology companies, WiseTech Global, Appen, Afterpay, Altium, and Xero. Is Afterpay a tech company, guys? Is it? It feels like it's just hipster lay-by. Tech companies are expensive simply because they offer a rare growth opportunity that most of us don't see across any other market segments, she said. They performed well last year, but we think this year will be the year for materials, energy, and cyclical sectors instead. So materials, energy, and cyclical. Mr. Rota thinks the tech sector will continue to rise simply because the market is flooded with cheap cash from aggressive RBA cuts. I think this momentum trade will continue in the tech space for a while, only effectively because of cheap money and reasonable good enough conditions to justify taking risks. Most bearish of the lot was Mr. Sydney, who said, I don't expect them to do too well. I suspect there will be weakness across that space purely based on valuations. I'd be surprised if they can continue to live up to those high expectations. Well, we're seeing that with a lot of the tech unicorns. Well, are they tech zombie unicorns, guys? Are they ever going to make a profit? So if those numbers aren't up to expectations, they'll be sold off quite heavily. So here's the asset price performance in 2019. Palladium up 56%. There you go. S&P 31. Bang stocks, iron ore. Where's gold and silver? Gold. US dollars up 18%. They don't have silver on it. No, they don't. Brent crude. So there you go. I mean, who invested in palladium last year, guys? Let us know in the comments. How'd you go? So wool is down. Thermal coal down. LNG down. Coking coal down. There you go. So beware of property trusts, utilities, and consumer stocks. Utilities and real estate investment trusts are the stocks that investors should avoid, according to most of the panel. Some of those stocks look overvalued at the moment. Stocks like GPT and Mirvac, for example, they look quite expensive, Mr. Sydney said. He added that Woolworths and Coles, giants in the consumer staple sector, should have reasonable growth, but you certainly can't justify their current valuations. Mr. Rhoda agreed that REITs and utilities will see less buying activity. Transurban is extremely expensive, and the REIT sector has been a bit up for a long way. Historically, they've provided good yield, but at the moment, are a bit of a risk at the moment. Meanwhile, Ms. Liu said, it looks like property trusts and some utility names will be sold in favour of other sectors, simply because they haven't done well in the past few years. Many of them are lacking growth at this point, so if investors allocating money to cheaper cyclical stocks instead, the returns will be much larger. What do you think, guys? What do you think? She expects to see a pickup for consumer-facing stocks in the later part of the year, potentially if there are more tax cuts come through in the May federal budget. But so far, the Reserve Bank and the Morrison government have failed to fire up the economy by lifting consumer spending, despite tax rebates and 3 interest rate cuts. Yes, because guys, consumer sentiment is down. Consumer sentiment is down. And here we go, a risky betting on cars. And finally, if you're prepared to take on major risk, Mr. Sohi suggested buying shares in ARB, AMA Group, Bapcor, AP Eagles, and the automotive industry. He believes there could be some recovery at some point, given car sales have been falling for the past 20 months. For patient long-term capital, there's an opportunity to pick up cyclically distressed businesses as the whole sector is going through a rough time, he said. I would be cautious, though. We've just been dripping money in those areas because things can get a lot worse before they get better. A lot will depend on what happens to house prices. And from here, as a lot of consumer spending, specifically car sales, has been correlated with property prices. So if we have a property correction, a significant property correction, what will happen to those car prices or those car stocks? They've been bleeding, haven't they? We've been avoiding for the last several years stocks exposed to discretionary spending, but now those falls have largely happened. You might start looking at them again. Before you act on any of these predictions, please remember share trading is a risky endeavor, so buyer beware. And here's the disclaimer: this article does not contain financial advice. We strongly recommend that you obtain professional advice before making any investment decisions. Which, well, is common sense, but common sense is a rare commodity these days. I suspect it's gone up in value by 100% over last year. So guys, there we have a perspective on the stock market for next year. I would love it if you could let us all know your suggestions and your perspectives on the market in the comments below. I frankly have, every time I played in the market, I've been either very conservative or I've gotten too emotional and made snap changes. So I'm just taking a much slower approach at the moment. Let me know what your strategies are, guys. And if you're a fan of the channel, please like, share, and subscribe. If you want to help support the channel, we have a Patreon where you can make monthly donations. We've also just activated or received the opportunity for you to join the channel here on YouTube and receive bonuses and emojis similar to Patreon. We also have affiliate links with Independent Reserve for crypto trading, Amazon for consumer purchases, and eBay for other consumer purchases. And finally, we sell our very own merch from the HeiseSays blog, Pocket Squares, handmade right here in Queensland. Take care, everyone. Have a great day, and I will talk to you all later. Bye for now.